Hey, this is Charles Carillo from Harborside Partners. If you want to learn how to use your small axe to build an empire, you should be listening to the Small Axe Podcast with my good friend, Nico.
Hey guys, it's your boy Nico here from the Small Axe Podcast. I want to show you how to use your small axe to build a lasting empire. You see, not everybody begins their investing career with millions of dollars, a huge network of investors, or the knowledge necessary to become successful in this space, and that's okay. What I focus on here on this podcast is helping you hone your skills, sharpen your tools to become the best investor that you can be. Now, I want you to sit back, relax, and enjoy this show. If you have any questions or you want to reach out to me or the guest, feel free to do so. Love you guys. All right, Small Axe community, welcome back to another episode. It's me, Nico. Today I'm hanging out with Charles Carillo. Charles is the managing partner of Harborside Partners, a real estate syndication firm, and has been actively investing in multifamily and commercial real estate since 2006. Since that time, he has invested in over $200 million worth of investment real estate. Charles is also the host of the Global Investors Podcast, where he interviews professionals about investing in U.S. real estate. Now, without further ado, I'm going to get this guy on because he's got a lot of really cool stuff to share with us. Charles, welcome to the show.
Thanks for having me on, Nico. It's great to be here.
I'm excited to talk to you. You have an extensive background, and we have some overlapping markets and viewpoints and ideas. So I'm really excited to have you kind of share your journey with the listeners. So can we take a few minutes to kind of catch people up to how you got to where you are today?
Yeah, so I'm originally from a small town in Connecticut, and I've been down in Florida since 2012. I grew up in the real estate investment business. My dad purchased his first multifamily property in 1984, a few months after I was born, and he self-managed that. He probably bought like a dozen properties, everything ranging from 3 to 18 unit properties with a partner, and they started selling off in the late 90s. But that was my first forte into real estate investing, and I wasn't really too impressed. They were like D-class properties and C- properties, so very difficult areas, very difficult tenant bases. Not something that anybody, that you put on anything. Any guru is going to push you to start investing in real estate. So after getting out of college, I kind of really fell into getting more into my dad's business in high school and following around a lot more. He pushed me after getting out of college to buy my first property. It was a house hack, which is now they call it that. It was really just a 3-family. I lived in one of the floors. I rented out the other 2. That was about a mile and a half from where I just graduated college. And a couple of years later, I went to another 3-family. Then I went to this is 2006. My second one was 2008. And then I bought my first small commercial mixed-use property, which was 4 apartments with 1 office underneath in 2009. And that was my first commercial property I bought in a very trying time in the market. And I self-managed them. I've self-managed those properties for 6 years. And then I moved down to Florida. I put third-party management in place of that. And since being down here, we've really focused on larger properties and then getting involved with syndications around 2018 or so. And that's, working with passive investors to buy larger projects. And our first syndication was 59 units. And now we really focus on larger properties, really 100 units. I'd go lower than that, but it's really, you got to have the scale to have the on-site management, which is always the killer. I don't have any problem with smaller properties. It's usually a problem with the management and getting that right number, you know what I mean, of how you're going to do it. So that's really where we are now.
Yeah, thanks for clarifying everything, Charles. You have a cool background, man. And those tweeners, right? We call them the tweeners. If it's 50, 60, 70 units maybe, and you can't really get that on-site management, it's at what point do you actually just go for a little bit more, a little bit bigger, and just get that on-site management? Yeah. All right. So talk to us a little bit about what you own and where nowadays.
So we've gone through over the last year. Yeah, over the last year and a half, we've sold 6 properties. So right now we have about 700 or 800 units under management, assets under management. Just 2022, we went through and we started selling properties. I sold my personal portfolio as well, stuff up north. We sold some properties in Tampa. And we've really we've really changed over the last 3 or 4 years, moving specifically into B class properties. So we have like really kind of narrowed our buy box down, and it's really 1985 or newer properties. Really want to get 100 units or 80 units plus is where I would go to, but really the buy box is 100 units plus, and we want to be in B class areas, B class assets, solid properties. The ones we were selling before were, the ones up north were really old, but the ones down here were what we'd call like Florida old, which is like built in the 60s, you know what I mean? But definitely they're more trying areas and it's more difficult. And I don't have a problem with C-class properties, but it is when you're bringing passive investor money into it, I really like to have B-class assets. It's just a lot more consistent in the cash flow, and it's easier to predict where those properties are going to go.
Awesome. So Charles, I'm still in the phase in my earlier phase where I'm looking at the C-class properties. I'm still doing C-class properties, but everybody talks about the transition into B-class properties because it's just less of a headache. There's just different issues, and maybe you could talk a little bit about the B-class and why you love it so much.
Yeah. So the issues with C-class, and I mean, I have decades of experience in C-class. It's a great asset class. The problem was that over the last several years in this run up we've had, the cap rates have gotten really close between B and C, and that's the reason why. And that's probably going to widen a little bit more with what we've got going on here. But they got really close, so you could buy a much better asset for just a little bit more. And B class. So a stat I read earlier this year is that it showed that a C class tenant has only about $400 in savings. And even if that's off, I mean, $800, whatever it is, I mean, it's still less than what you're charging people for rent per month. So if there's any type of hiccup, the C class tenants are going to get hit first. And that was one thing that when we went through COVID and anything like this, we didn't have any problems with properties really performing. But where we had to pause distributions were on our C-class assets during times of going through COVID and afterwards, as all the different rent programs expired. And B-class assets, we didn't have to do that. And we got very good returns on our C-class assets for our investors, but it was just something that it's much more difficult dealing with C-class assets with investors. If I went in with like a joint venture and I bought it with like you, me, and a couple other people, that's no problem because we understand that there's going to be ups and downs a lot more drastically I've seen in C-class than in B. So that's just the main thing I've seen is really the consistency. And also that it's easier when you're getting into larger assets to bring in like family offices for some preferred equity when you're buying these larger properties. So you're bringing in these larger, almost institutional people to partner with you and put up usually about half the cash that you need to buy them. And they don't really want to do that with your C-class assets.
Yeah,
I found. Yeah.
No, very well said, Charles. And I want to get a little bit better picture of your team. Is it, are you Harborside, or do you have multiple people for Harborside, and who do you work with, and is it consistent, or do you do deals with different people?
Yeah, that's a great question. So Harborside Partners is myself. I have two partners, and then we have three other people that work with us, like kind of in our back office, handling investor stuff. Our firm focuses mainly on working with passive investors. And what we have done over the years is I've transitioned our firm really to we work with predominantly three main operators that for many years, and multiple markets. And we have three main markets that we're really working on: Dallas, Greater Atlanta, and then I call one market, but it's really between what we call the I-4 corridor here in Florida, which is really going from Jacksonville all the way down to Tampa, which is multiple markets. But that area, and that's really in my backyard here being in Florida. So those are the areas, markets that we really like and that we really kind of focus in on. And the main thing is that when you focus in on what you're doing, we have operators, boots on the ground in those areas. So if we're not there, we have someone that just specifically focuses on that area. And we've really highlighted these main markets as where we understand the rents there, we understand the growth there. And, they're going to be great. They've been great markets for the last couple decades, and it's going to continue for decades to come. As you know, you're down there too, investing down in Florida.
Yeah. Charles, you have so much experience. I want to get the listeners a taste of that. So let me start a little bit by backing up. So in 2009, you said you purchased that. It was up in Connecticut, I believe, or somewhere. You purchased
Yep.
something, And that was the height. That was when shit hit the fan, or was about to hit the fan, right? And you went through that, man. And then you went through COVID, and you went through the ups, and now we're kind of swinging on the back down again. Um, so back to 2009, was that scary come 2010 or 11? Because you then moved down to Florida in 2012, and you held that property. So I'm assuming you were cash flowing. Like, what was that like through that transition?
Yeah, and I sold all those properties the beginning of 2022 to an investor out of New York, and as a portfolio deal. And well, I brought my first one in at the end of '06. I didn't know any better. I had no idea what was going on, and '07 seemed like it seemed like a great investment. And then end of '07 came around. '08, we all know what happened there. I bought my second property. I remember it's October 1st, 2008. And I remember that date because it was like a couple months before Madoff, and it was a couple months after Lehman. And like every time you turn on CNBC, there was just like red. There's like it's a meltdown. Washington Mutual. People don't even know who that is anymore. It's gone. It was just like everything was just going to hell. And I had an idea. You can have an idea too, because when I was buying that second property, I contacted the people, real estate professional people that I'd worked with prior, inspectors, agents, and they're all out of the business. And I was like, oh, this is a warning sign, right? And not like they were like just doing something different and they had their licenses. Nope, no licenses, no nothing. Their websites are down, like everything. It was blood in the streets. And '09, it was even worse, because if you bought property, because we did some flipping of single family houses during this time too. And it was like, the key was finding properties that were 1 to 4 units and you could sell to someone with FHA. If you were buying properties that were really like 5 plus, and I don't know what the number went to, because I bet like Fannie and stuff, I wasn't involved with them. These larger agency people were still lending, but like we didn't really have like bridge debt. There wasn't really like hard money lenders that were like lending on these properties, because there was no exit strategy. You know what I mean? You could still cash flow, and cash flow was great, but no one wanted to loan anything. And I'll give you an example. So when I bought that property, I bought it. It was it was on the market for maybe 40% of what it sold for 2 years earlier in '07. And it is sitting on the market. I have a printed out listing of what it was. And to remind myself, 120 plus days it was on the market. Contacted them, put an offer in 30% less than what they were asking. They came right back, best and final, all this kind of stuff. I went up like 3% and they took it. And I purchased that property. I did all this work to it, spent like 100 days. This thing was completely vacant. 100 days with my contractors, get this whole thing, got it up and rented, went back to banks, because I was trying to get like a line so I could do some like flipping of other houses and stuff like this. And I was literally a bank that my family had banked with, and I had a bank account with, business bank account with, all stuff. And they were like, going to give me like 15% of the loan to cost, not what like I would value it with, like, you know what I mean, but like loan to cost. And it was it was just like, it was nothing. And you're like, oh, well, what? And there was all these stipulations too. It was like a million things that no one was ever going to do. It was like, I had to like move some company to a different state. You know what I mean? I had to bring to Connecticut and register it there, and all the stuff that you're never going to do. And because it was registered in Florida at the time, and you're like, okay, like this is never going to happen. So it was, you had to have everything cash. So it's like, it just goes to show that the real estate is like so dependent on debt. And it's whenever there's some kind of wavering thing, which we're seeing now with the interest rates, as you were saying, you start seeing before the recording, we were talking about how you're looking at and you're finding better deals. Maybe prices might be coming down because of interest rates, or sellers are actually coming to, terms with rates aren't going down to, where they were before 3 years ago. So it's just one of those things that when that happened, it is what it is. You get great deals. You can't refinance them. They cash flow crazy, but you're not gonna, and I did all of the numbers when I was buying it, not to value. I didn't really even know what value adding was. You know what I mean? I was 25 years old. So it was something that it was really just, I was doing work to the properties. I was getting rented out and making a couple $1,000s a month in cash flow on those properties while putting my office in that little office space below. But if you're buying anything that was those small commercial properties, they were sitting on the market for months because you need cash for everything. You couldn't get a dollar anywhere. Even private money lenders, like finding private money lenders, they didn't care about any work that was done to the property. they would go back like 2 years, find the assessed value and use that as the value of the property and then give you like 50%. So it was like, I would have done the same thing. Like, you had no idea. It melted down, and I didn't see it until later because people were like, oh, how'd you go through it? And all my properties cash flowed, and I had no debt or long-term debt on them. And it was like, I just like, that's it. You just buy for long-term capital, long-term cash flow, long-term properties, and you're not like flipping properties. You're not going to lose your shirt. You know what I mean? But tons of people I bought those first couple of properties for went through really tough times. They were bigger landlords at the time, and like they had construction projects, renovation projects, heavy renovation projects on single family homes. And you just drive by those places, they were all just tarped up for many years to come. You know what I mean? Just because everything ended. You know what I mean? So it was a bloodbath. You got deals, but people don't know. They're like, oh, you got great deals, and the look on the thing, oh, this is what you paid for it. Man, like, it's there's nobody lending money. Yeah.
Right. You had to have dry powder. You had to be ready. You had to have the right resources. And it's not for everybody. And you stuck through it. And then you made it all the way to 2022 when you sold, which is I'm assuming that was a pretty good time to sell.
Yeah, it wasn't I had a property manager that was retiring, and I wish I would say that it was my timing, but no, it was a property manager that was retiring, and I was like, okay. And I was like, I had one property with my brother as a partner with it, and we just like, we're like, all right, we'll sell it all. And we went to a broker and we sold them all. And we had like a terrible property manager in the interim between it. So I was like, all right, I'm just like done with all this. It comes down to, it's so important that your properties, like the property manager, you realize when you have a bad manager, how important a good manager is, because it's like this thankless job. So it's like the property manager is like super important. And whenever we partner with anyone, whether I'm passive investing or whether we're co-GPing on a deal, it's like the property manager is like one of my really big due diligence pieces. You know what I mean? Who's managing in this, and what is your history with them? Because if this is your first property with this property manager, I'm done. I'm like, this is a no-go for me, because you don't want to go through that whole process of moving managers, because it's a nightmare. Even if it's I don't know, 15, 20 units compared to 200 units. I mean, it's still a nightmarish process that takes many months to convert over.
Yeah. Wow, man. So much insight you have. I'm going to keep digging here, man. So when you maybe you can kind of talk to us about your favorite deal right now that you own, and give us some of the aspects of why you like it so much. It could be the property management team, it could be the GP team, it could be the location, the market, the whatever it is. Just give us a little bit of insight on one of your favorite deals right now.
Yeah, so one of my favorite deals is we have a deal. It's a large one. It's 536 units, our largest one ever in Dallas, and it's with a team that we've worked with before. Number one is they have in-house property management, which is good. They have a lot more control of the property when you're dealing with someone with in-house property management. But the main thing is that they have about 2,000 units, and they have about 12 or 1,300 units within a 15-minute drive of this property, and they only focus on Dallas-Fort Worth. So when we had worked with them, one of my partners had done a deal with them prior. And when we did this deal with them, that was a huge thing, because we knew that there wasn't going to be any change in management. They knew the area inside and out. And Dallas is just being a really growing area. And we definitely got a price break. The first real one I saw, this was, we bought this a day before Thanksgiving and closed on it in 2022. And it's just, a property that probably we paid $109 a unit for it, and built in 1985, about 15 minutes from downtown Dallas. And it probably would have sold a couple years before for another 15,000 higher than that. You know what I mean? So maybe it goes down lower. Who knows? I'm not a timing the market kind of person, but when you see a deal like that, a property that's been done, and the prior people we purchased for, they put $5 million into the exteriors of the property, and they bought it in 2017. So they had some debt coming up due. They had to get rid of it. However, they had a very low basis, and they did very well in it as well. And now we came in there, and they're going to work with us a little better to make sure that we bought before their debt came up. So it was it was a good deal, but you have to be. I always like kind of get weary when people are like, oh, and wait for the bottom. Well, no one really knows where the bottom's going to be. You know what I mean? And no one really knows where the top is either. So if you're waiting for anything like that, you really just gotta have your business plan. If your business plan is to make X amount percent and do these many units and then sell it or whatever, once you get close to it or you've achieved that, that's when it's time to sell it and to find another property.
Awesome. So Charles, what kind of debt do you guys have on that five? Is it 536 unit?
Yeah. It's a what we have on that is we have it's a 5 year with we have a it's floating rate, and it's our rate's like 5 point, it's like 5.5, and we have a 2%, our cap goes up like 2% over that. So because right now we're capped out like right around 7%, something like that. So it's a great property. I mean, we can refinance that out. We've already added value to that property. We're going through renovating it. We're doing it about keeping it about 90 to 91% occupied. And then we're doing over about 4% of the units at a time as we're going through. There's 4% of units, let's just say, that are in our actual work, doing renovations to, and the other percent is ones that we are actively renting or just cleaning, repainting, and renting out, not doing all the renovations at once on every vacant unit. But that's what we have. It's floating rate, but it's if you're comfortable with it, we're comfortable with it. That's kind of like how we go about it. I haven't really been scared of floating rate debt. I think the big thing is that what I found with floating rate debt is that when you get into something, you're like, oh, I always want fixed rate, and I was really for many years only fixed rate debt. But then you start seeing the prepayment penalties that come up with it, and now you have to work that into what you're doing. So with us doing this deal, it was something that we knew we were going to be refinancing, and our lockout period on refinancing it was 12 months. And then after that, we could refinance it out. So, where we are now, if we put long-term debt on that, would probably be somewhere in the mid sixes. So it's not far off. It's much different than if you were regular, 3%, and now it's going to 8% or something like this. You'd have a whole different issue on your hands.
Yeah, well said. Awesome. And do you know, um, so you mentioned there that they have in-house property management. I mean, that must be a huge team that they have. Do they also manage other properties, or is it just their specific team?
Just their specific team, and my one of my partners I had done worked with our operators there before had they had an issue with a third party manager, and that's why they transitioned it. They had like a huge issue like 2018 or something with a property manager, and that's when they transitioned into doing their own in-house property management. So that's just when you hear that, you understand that they now have it, and they can keep the costs a lot lower, and there's a lot better of a control on it, because you give up a lot of control with the property manager. You're really putting this whole asset into your property manager's hands. And yeah, you're doing like an asset management on it, but you're only brought in on certain things. You know what I mean? And depending on what you feel comfortable with them and so forth. But I mean, it's really important that property manager. So it's having that in-house and having that control is a great thing. And we still work with other operators that don't have their own in-house property management. But if they have a seasoned track record with them, then that makes me feel great, because then I know that they're going to be there. They've worked together, and we're going to be able to get the units renovated, and we're going to be able to get these units rented very quickly on the ones that were just, let's just say, painting and cleaning and re-renting.
Terrific. Yeah, and so when we're bringing on investors, you have to tell us, paint this whole picture to them. And I kind of wanted to ask you, because this question is also pertinent to me currently, but when we're bringing in foreign capital, is there a special way that you go about doing that?
Yeah, so foreign capital has my first limited partners were from abroad, yeah, from Europe, and so I wouldn't say the majority of our money is from foreign investors, but we do have foreign investors that are in our deals. The main thing is really when they contact us, if they are interested in being a passive investor in one of our deals. Normally, the first thing that we'll do is we'll provide them with a list of different professionals here in the United States, attorneys and accountants mainly, that work with foreign investors, because everyone's going to have their specific requirements. And you'll have some investors that want to invest $50,000, and you'll have some investors that want to invest, 8 figures after so many years, right? So it's going to be definitely a different asset management plan. And the main thing is that, for us being, American citizens, when we have a deal like this, our state tax is like cap, it ends at like, I don't know, $10 million or something. For a foreign investor here, their estate tax is like, starts at like $60,000. So it's a completely different plan. And, I don't really, become a professional in doing this and giving them, pointing in the direction. But mainly what happens is that they'll usually set up a LLC here in the United States, owned by themselves in whatever state, and then they set up a bank account here. And then when we're doing a deal with them, as them being the passive investor, they will invest through that LLC into the deal. And then all the proceeds will go back out to all their distributions. And when we sell, we'll go back out to that LLC or that LLC's bank account. And that's traditionally how the plan works. The other things that really, when you're working with the professionals, is making sure that tax treaties between the countries. This is a big thing when we have Canadian investors in our deals. You can't use an LLC. You're using a limited partnership now, right? Because of when tax treaties were done between Canada and the United States, there was no LLCs. So it's interesting that you're aware of this and getting these investors started much earlier. If they see an email that you sent out for a deal that you're trying to close on in 30 days, they're not going to probably be able to be ready for that deal. It takes months in advance preparation to get their whole estate plan ready for here investing in the United States. And there's other people that have done it just do it through their own name and stuff like that. But we have strict protocols because we make sure that the money, when it hits our escrow account, it has to come from a U.S. bank account. So that's one thing that we are sticklers on. And the main thing for that is because of the KYC, know your customer. So I don't have the resources of Bank of America. If Bank of America opens up an account for an international investor, they've done their due diligence, or I hope they have. And that's what we can rely on when we're taking funds from them, because there's no way, you're not going to Google someone and find out if they're on a terrorist watch list, right? Or whatever, you know what I mean? Or some sort of blacklist. So we just make sure that when it comes to us, and I suggest anybody else partnering or taking money from any foreign individuals, they do the same way. Have people set up their own, corporation here in the United States. You can partner with that however you are, and then money flows in and out of their U.S., corporate LLC bank account. So that's kind of how we've done it and been successful doing it.
It's great advice. And it's actually easier than I thought. I thought you had to set up a whole fund of funds to get investor capital in. Not that it's necessarily easy, but it is different than what I thought. And I will be speaking with attorneys to kind of get their take on it as well. I appreciate that. So Charles, let's talk about what you plan. How are you seeing the world right now? Are you still looking at deals? And then what about the future?
Yeah, so 2023 has been a little slower for us. Deal flow really slowed down in quarter 2. One of my operating partners really just kind of really paused on underwriting deals. I'm not really sure exactly where we are. We hear so many conflicting news of what's going to happen if we're on our way back up, or if we're still waiting for something major to happen. Within multifamily, like we were talking about before, I think you start seeing sellers that are coming to terms, and I think all types of investors and sellers that are coming to terms and figuring out that the rates aren't going to be going down to what they were, and we're going to be higher for longer, right? Is the saying that they're saying now. So I feel that that's true. With it coming to the floating rate debt, which I know that's on everybody's mind with these deals coming up, that people might be a little bit more motivated to sell. And I really think that's going to be something over the next 12 to 18 months, because if anybody took out floating rate debt and was smart enough to do a rate cap, they most likely, like we had done 2-year rate caps on our deals. And because a 3-year rate cap back then was almost twice as much as a 2-year rate cap. So with that being said, with our interest rates going up in 2022, how they did, I feel that mid 2024, we're going to really start seeing these deals. Now, we don't know if we're going to see them. We're going to see something happen with them. So we don't know. I'm still not sure that these are going to be coming on the market, because maybe you'll have less than ideal properties, right? Might be coming on the market. The banks might get rid of them and say, we don't want these on our books, or we're not going to work with them. But if you have better properties, if they have, if they have paper on better properties, they might work out loans. That happened a lot. And I'm just saying this with residential properties. I remember I had contractors that had gotten behind on mortgages in 2010, 2009, and the banks came to them and were like, okay, we're changing we're changing this mortgage to 40 years at this fixed rate, blah, blah, blah. And all they're doing is just they know the person's not staying there for 40 years, right? They're just kicking the can down the road, being like, okay, hopefully the price of the property gets over what we owe on it in 36 months, right? Whatever the magic number was, I imagine is what they were saying behind their doors. And it happened. That's what those contractors sold their properties. The bank got their money back, and they didn't have to go through costly foreclosure process. So you don't know if that's going to happen too. So we're really seeing what's going to be workouts, where some lenders are going to extend maybe a little bit more some of the terms they had to keep deals from going south. You know what I mean? But I think some of those, if you have floating rate debt and you're getting behind on it, which you probably are if you have like D and C minus type properties, those are the ones that are probably going to be taken back and sold, because you're just not going to see probably much of it. It's going to take a while for those to get back up to value. You know what I mean?
Yeah. Charles, I can't believe how much knowledge you have, man. You're really, really, yeah, you got a lot of experience, man. So I appreciate this. Let's wrap it up here. I'm going to give you my final question, and then I want you to give the listeners some form of contacting you, because they're going to want to reach out to you and learn more about you and how they can invest alongside of you. So let's jump into it. Let's imagine, Charles, it was 100 years from now when you have great grandchildren. They wanted to write a book about you to honor you and your life. What would you want them to title this book?
Growing, because I started off when my first job was doing, my first company was a pay and processing company. So I'd be like, from pay and processor to real estate entrepreneur, something like this. I would say probably like this. And then, all my trials and tribulations through there.
Cool. I like it, Charles. Thank you for sharing that. All right, let's get the listeners some form of contacting you.
Yeah, thank you so much. So my company is harborsidepartners.com. And if you go to harborsidepartners.com, I have a ton of information on there. We have Nico's going to be a guest on the podcast coming up, YouTube channel. I do 2 episodes myself every week. One of them is an interview based, and then I do another one called Strategy Saturday, where I just kind of go through different strategies and different things that I'm learning or stuff that's coming up. They're very short episodes, and so a lot of information on there for free. If you're interested in passive investing, reach out to us. And then we also do some active work with active investors in like the mentoring space and stuff like this. So if you're interested in any type of multifamily investing, reach out and get connected with one of us.
Yeah, awesome. Guys, please reach out to Charles. He's a great dude. Obviously, like I said a bunch of times on this episode, he's got a lot of experience, a lot of knowledge, really, really helpful and insightful. So Charles, I really appreciate you coming on today.
Thank you so much for having me on.
All right. Hey, Small Axe community. I would like to say thank you for listening to another episode of my podcast, where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. Book a call with me. And until the next episode, keep sharpening those axes.